Stock that is in our radar or in our scheme of things today is Happiest Mind. But the stock surges on the back of a strong third quarter performance. To give us the fine print for the third quarter and the outlook for the rest of the year, we have Joseph Anantharaju, the Executive Vice Chairman and CEO of one of their verticals, and Venkatraman Narayanan, the MD and CFO of the company. Thanks a lot, gentlemen, for joining in. Let's start with you, Joseph. If you could tell a little more about demand environment, how your growth rates have been. Were you growing? You were growing at close to around 20% with the COVID boost now. How much better can growth rates be?
If you look at the growth rates, we had guided when we went public that we would do 20%, and that's something that we want to hold on to. But in terms of the demand environment, we have seen a good build-up both in existing customers and new opportunities. As you would have seen from our press release, we had 6 new wins or deals that we announced for the third quarter, and we're seeing traction across all the geos that we are present in. That's Middle East, Australia, which are more newer geos, Europe, India, which are a little small, and hearteningly US. And in terms of vertical, what we saw in December is Edutech, which was doing well. We saw new requests and new projects getting bubbled up and budgeted for, which then translated into needs and requirements and ramp-ups in January and February. We also are seeing, we also saw the online media space seeing quite a bit of traction, the e-commerce part of retail and high-tech. But what we've seen after coming back from the holiday season is that the industrial space and the B2B distribution logistics space also seems to be having a lot of new initiatives being kicked off, which is leading to demand.
Okay, got that. Let's go across to you, Mr. Venkatraman. Just for FY22, do you think that margins can stay above this, the margins are sustainable in that range of around 21 to around 23%?
Yes, the last 3 quarters I've been holding on to the 21 to 23%, but we have ended up doing much better. Just like what's happening on account of the pandemic, there are some certain imponderables which we have now coming to grasp with. During the call, I've also now started giving a forecast of saying let's look at a number between 22 to 24%, because starting April, we'll see pay increases. We'll start seeing some bit of travel coming back once vaccination is back. People are going to return to office. Our idea is to get people back to work, back to office. So with all of that, some of the cost savings that we saw, we are likely to give up on when you come to FY22. But like Joseph alluded to, we'll see revenue growth picking up. Our long-term plan is to do the 20% on an organic basis. Inorganic bolt-ons obviously will add to that growth rate. And coupled with that, we are also now talking about retaining those efficiencies. So we have seen efficiencies over the last 3 quarters. We are going to retain some of those efficiencies. Our utilization is at an all-time high of 81.6%. Attrition is at about 13.1%. Given the demand scenario, obviously there will be certain tracking issues with respect to attrition, but that's something that we will address very constructively over the next 1 year. So all put together with the expansion in revenues, expansion cost, we are kind of forecasting EBITDA margin of between 22 to 24%. And that's what we try to guide to. But while all of this, I would like to caution that any investment required from a customer or from a technology standpoint or investment in terms of people, that's not something that we will hesitate to do, because as a technology company, saying that we can't do a certain bit of work because we don't have the capabilities is the last thing that we want to be seen to be doing.
All right, take that point. Joseph, back to you then. There is a sharp drop in your EdTech revenues. Can you explain why, and when do you think retail will rebound?
Well, the first time I saw that number, even I was a little taken aback and dug a little deeper. If you see on an absolute basis, as a percentage it's dropped, but if you see on an absolute basis, it remained the same. And what really happened is that the budgets that I was talking about, the new initiatives that we're seeing in the Edutech space, and just to give you a little bit of color, it's what we are seeing customers trying to do now is adapt their platforms and technologies to more of a hybrid environment. What they did for the last 9 months was more around remote learning. Now they're trying to support, a mixture of remote and in-person. And so you're seeing things around adaptive learning, predictive learning, and more, interactive experiences, which is what they're investing in. So some of these initiatives have got budgeted for in December. And as I mentioned earlier, they've got kicked off now, and we see Q4 being quite a bit of growth for the edutech segment.
Well, let's talk a little bit about your balance sheet, Mr. Venkatraman. The cash on the books is what, around 550, 540 crores approximately. How soon can you close an acquisition? And will you look at giving dividends as well, return some value to shareholders?
Two parts. One is on the acquisition, second is on the dividend. On acquisitions, we just completed an acquisition. We had put out the release on that one to the exchanges. It's a company called PGS Inc., about $10 million in size, and we have paid about $8.25 million for it. So funding for that is something that we have now done effectively by borrowing from relatively cheaper sources like FCTL and such. So continuing to maintain the cash balances, because we maintain cash balances. One is from the IPO, which is being used for working capital, and we use working capital borrowings. And we are also continually generating about 50-60 crores every quarter, if you look at it as free cash flows. So yes, you're right, 540 crores plus of cash balance. We will be deploying it to look at companies. As we have said in the past, we are very actively looking at companies, size of between 10 to 30 million, but more than size, what we are looking for is competency, capability, any gaps in our digital service offering that can be effectively filled or backfilled for that matter, profitable with good customers, and which is also able to integrate well with Happiest Minds, because we have a very cohesive culture. So we also look for a culture fit. So continuously looking for companies with all those benchmarks out there. And when we see that at the right valuation, obviously we'll look to buy. So that's on the acquisition side. On dividends, yes, we have not paid dividends as yet. We have in place a very progressive dividend policy, and we hope that the board will consider and declare dividends at the appropriate time. Yes, but that's something that will be considered.
All right, we will take that point, Venkat and Joseph. Thanks a lot for joining in and giving us all those details. That's the management of Happiest Minds. The Happiest Minds today, though, would be their shareholders sitting with a gain of almost 11% in today's trading session itself. With that, we slip into a short break, but